Okay, so we are moving to our next question. So question 2. So question 2 is on elasticity. Okay, so with the question 2, this is the word problem type of elasticity. We have the table type of elasticity, and we have the word problem type of elasticity. So we will solve the first one with the word problem, then we also solve the table type so that you get both concepts. I won't forget, I would attach the questions to the video so that you get the concepts. So I'm reading the question. In the economy of Queensland, so the question is pertaining to Queensland. So in an economy of Queensland, two products, STA and star. So products involved in the question, we have STA and we have star. So in an economy of Queensland, two products, STA and star, are prominent due to their quality and durability at the price of 30 Ghana cedis for STA. So STA, we were given a price. So initial price, let me do it P1, was given us 30 Ghana cedis. Let's just divide it. Okay. So at the price of 30 Ghana cedis for STA, 5,000 quantities of STA are demanded. So meaning initial quantity. So the quantity I'm doing it QT1, which is Q1, was given us 5,000 quantities of STA are demanded. So I'm starting. In the economy of Queensland, two products, STA and star, are prominent due to their quality and durability. At the price of 30 cedis for STA, 5,000 quantities of STA are demanded. Stonewall, a banker, lives in this economy and earns a weekly income of 2,000. So meaning, let me clean. Okay, you let me leave it there. Let me do it. Let me create it here. So income. The income. So we are picking the income concepts in the word problem. So Stonewall, a banker, lives in this economy and earns a weekly income of 2,000. So initial income. So initial income, which is I1, was given us 2,000 Ghana cedis. At this income level, they are making an emphasis. At this income level. So they are laying an emphasis to the previous statement that was made. So at this income level, Stonewall consumes 100 quantities of star monthly. But take note, every information you are mentioned in the question is pertaining to the income side. If it's star, give everything to star. If it's pertaining to STA, give everything to STA. That's the concept. So at this income level, Stonewall consumes 100 quantities of star monthly. So at this income level, so we have quantity. So let me do it. Initial quantity. Which is Q1 as 100. Now, the price of STA, the price of STA increases by 50%. It increases by 50%. So let me do the workings here. So let me name this side workings. So this is our final table. So let's do the workings here. Let me do it here. So the workings. the price of STA, so the price of STA was 30, it increases by 50%. 50%. Now take note. There's a difference between buy and to. If it states that increase 50 cedis to 100 cedis, it means we are no more going to use the 50 Ghana cedis, but now we use the current amount, which is what? The 100 cedis. Let me give a recap. Increase 50 cedis to 100 cedis, meaning that you would have to ignore the previous amount, which is the 50 cedis, and focus on the current amount, which is what? 100 cedis. That is if the question uses the concept of 2. But with this question, they are saying that the price of STA increases by 50%. So this is the price of STA. So STA, the P1 was 30 cedis. They are saying this increases by what? 50%. So increases by 50%. So we have 50 over 100 times this amount. $50 over 100 times 30 would give us 15. So I have this 15 here. Now, this 15 is based on the percentage increase here. So now, we want to know the new amount. What will be the new amount if there is an increase of 50%? This is just giving us the percentage increase difference. So now, if I add this percentage difference to my amount, what will be my new amount I'm going to what? Incur? Or what will be the new amount I'm going to have in my account? So I add this 15 cedis back to this 30 cedis. So P2 becomes 30 cedis plus 15 cedis, which gives us 45. So our new price is what? 45. So I'll come to this side. New price, which is P2. I'll do it 45. So let me continue with the question. So the price of STA increases by 50%. Now 4,000 quantities of STA are demanded. They gave us the new quantity, 4,000. Q2, we have 4,000. As the initial price of STA, 1,000 quantities of star were demanded. At the initial price of STA, which is 30, 1,000 quantities of star were demanded. So initial quantity for star which is Q1 is 1,000. But at the new price of STA, which is the 45, 3,000 quantities of S star were also what demanded. So new quantity. So I'm doing it Q2, new quantity. So Q2 was given as 3,000. Stonewall attains a professional qualification. Thus, his weekly income increases by 20%. So income. So this is workings 1. So workings 2 was for what? Income. So his weekly Store attains a professional qualification. Thus his weekly income, which is the 2,000, increases by 20% at the new income level. So this is his initial income, I1. It was 2,000. So this increases by 20%. So 20 over 100 times the 2,000. So 20 over 100 times 2,000 would give us 400. So we are finding our new income. So the new income becomes the increased amount, or the increased amount plus the initial amount we were using. So 2,000 plus 400, that gives us 2,400. 2,000 plus 400 gives us 2,400. Yes. So this is our I2. So I come to this side. New income, which is I2, is 2,400. So Stonewall attains a professional qualification. That is, weekly income increases by 20%. That's the workings I just did. At the new income level, which is this one, he consumes 200 quantities of star monthly. So new quantity, which is Q2, was given as 200. So this is where all the information we were given. So this is a word problem. I would attach the question. So when you read a question, then you would have to deduce the information like this before you start answering the questions. That's how we do it. This is the complex type of elasticity you could ever get in business economics, not the higher, let's say, level. Yes. So now I'll claim my working since I've written all my answers down. So the A part of the question states that determine the own price elasticity of STA. So own price elasticity of STA. Now, with own price elasticity, this is the formula we use. APX is equal to change in QS over change in PX, which implies that I should have Q2 minus Q1 divided by P2 minus P1 times P1 divided by Q1. This side, they are the initials. Let me say it that way. So we pick, so I'm continuing to this side. So now, own price, but we are dealing with what? STA. So we'll pick everything from here. So the first one is Q2. So our Q2 here is what? 4,000. Minus Q1. Our Q1 is what? 5,000. All divided by P2. Our P2 is 45. Minus our P1. P1 is 30. This is 30. So this is the concept. What we have here would come on top here, divided by what we have here would also come to the down part, like this. So you can use the calculator to punch the answer. So 4,000 minus 5,000 divided by 45 minus 30 times 30 divided by 5,000. So 4,000 minus 5,000 divided by 45 minus 30 times 30 divided by 5,000. So we have our answer to be minus 0.4. And per the concept of own price elasticity, the question states that determine the own price elasticity for STA and interpret your answer. So with own price elasticity, they have their own interpretations. So with the interpretations we use for the own prices, the first one states that with this, we call it slash. By the economics, we call it the absolute values. So the absolute values of own price, if it's less than 1, then it's inelastic. If the absolute values of own price is greater than 1, then it's elastic demand. We have situations whereby we use fairly elastic, fairly inelastic, but I will just let you guys focus here. Are you good? When you are doing managerial economics with us, we don't just state them like this. You would have to state the actual thing, fairly elastic, fairly inelastic, like that. But for now, let's just take this per your level. Okay. And the situation whereby the absolute values of own price is equal to 1. That is what we call the unitary demand. So now, we will pick absolute values of APX. So what we have here is less than 1. So this is the absolute value. So this number is, when we pick the absolute value, this number will be less than 1. That's why you see less than 1 here. So this is 0.4. So why are we using the absolute value at all? We use absolute value to eliminate all negatives. So one would ask, so what if it's a positive number like 0.8? Would I still take absolute values? No. We only take the absolute value when your answer for own price elasticity is negative. But if it's positive, you just interpret it. But once it's negative, that's when you take the absolute values. So let me clean this. So this is 0.4. So from this side, it's less than 1. So it's inelastic. So this is inelastic demand. So I'm done with the A part of the question. So with the B part of the question states that determine the cross price elasticity of demand for both products and interpret the relationship between the two products. So cross price elasticity. Cross price elasticity. Between cross price elasticity between STA and star. So now, cross price elasticity 2. This is the formula EXY, change in QS over change in PY. That stands for related products. So it's expressed as Q2 minus Q1 divided by P2 minus P1 times P1 divided by Q1. So cross price elasticity. Assuming I want to buy this calculator and it states that the calculator is sold for 50 cedis. So meaning that I'm supposed to pay 50 cedis at the bookshop to purchase this calculator. But I end up paying 100 cedis for this calculator. So meaning I have crossed the product. When you pay calculator, pay the same price for calculator. Don't pay the same price of a different product. So now we own price. If you are picking a product to be yam, pay the same price of the yam. That's it. If you are picking cassava, pay the same price for what? Cassava. You can't pick yam and pay the price of cocoa. No. That means you are dealing with what? Cross price elasticity. That's the concept. So now, for STA and what? Star. So most times the cross price elasticity, people or students sometimes have conflicting issues here. This is the whole ideology about this thing. You have two products in question. We have STA, we have star. For instance, with the question with the star, they were making reference with the prices of what? STA, but they didn't give us price of what? Star. Are you okay? So what we do is you would compare the product in question. For instance, STA, it has price, it has quantity, so everything is perfectly correct. But when we come to star, we only have what? Quantity. Are you okay? So what we do is with the formula, the quantity side, you use star because it's only star that has quantity here. Then when I come to the STA side, I'll pick their price. That is the concept of the cross price elasticity, because I'm picking quantity for star, but I'm rather paying the price of what? STA. So I have crossed it. That's the concept. So Q2, yeah, this is 3,000. So this is 3,000 minus 1,000. I have 1,000 here, divided by the price here. This is 45 minus 30. This is 45. And this is 30. So the number here comes here, divided by the number here also comes here. This is 1,000. So let's use the calculator. 3,000 minus 1,000 divided by 45 minus 30 times 30 divided by 1,000. We had 4. The answer is 4. So with the cross price, we also ask to interpret. Now with the cross price too, with the interpretation, so with the cross price, this is what we do with substitute and what? Complementary good. Now, if it's positive, then it's a substitute good. If it's negative, then it's a complementary good. So here it's positive, so it's what? A substitute good. That's how we do it. So we move to the C part of the question. So with the C part of the question, determine the monthly income elasticity of demand for star. So C, income elasticity. So with the income elasticity too, we have EI, percentage change in QS over percentage change in income. It's expressed as Q2 minus Q1 divided by I2 minus I1 times my initial income divided by my initial quantity. So I have this. So I'll come to the income side. So Q2 was 200. Q1 was 100 there. I2 income 2,400. The previous income was 2,000 times initial income 2,000 divided by initial quantity 100. So I have 2,000 minus 100 divided by 2,400 minus 2,000 times 2,000 divided by 100. 200 minus 100. 200 minus 100 divided by 2,400 minus 2,000 times 2,000 divided by 100. We have 5. So the answer is 5. Now with the income too, it has interpretations. If it's positive, then it's a normal good. If it's negative, then it's an inferior good. So what we have here is positive. So it's a normal good. So this is how we solve the word problem type of elasticity. So we also solve the table type of elasticity as well.